Okay, well, after a good 20 minutes of fiddling with my microphone, I don't know if people are anticipating this as much as I am, but Container Bytes, we're back. Hi, Judah.
Big time. We're back.
It's been a while. You good?
I'm good. How about you?
I'm good. Better than the Straits of Hormuz. Segue. Haha.
Not hard.
I thought about that for a while. Well, ceasefire, right, between the US, Israel, Iran. We're now maybe, I don't know, a day and a half into when it was initially announced. Without getting into the geopolitics of this, what are we looking at right now in terms of ocean freight and the Straits of Hormuz?
Yeah, so I think de facto it is not open, right? There's a uncertainty is the name of the game. There are the US saying it is going to be open. It's not what you're hearing from Iran, but the facts on the ground is that it's not open to transits as usual for sure. Certainly not to container vessels. If it does open, there is something like 100 or more container vessels that have been stuck there since the end of February. A handful have actually gotten out. Costco moved a vessel, as is CMA CGM. These were in coordination with Iran and possibly, you know, also via payment to Iran. It's unclear. The rest of these vessels, if the strait does kind of open completely, which doesn't seem like an immediate likelihood, those vessels might go out, but they're probably a lot less likely to go back in. So in other words, even if it opens and carriers are able to get their vessels out of the Persian Gulf, they're likely not going to just start, doing usual, typical port calls into the region because of the uncertainty. They're not going to go back like we saw for the Red Sea. They're not going to go back in full until they know it's safe and that they're not going to get stuck again. So that's kind of the story now. Again, a lot of uncertainty. Operationally, though, it's still really limited to volumes trying to get in or out of the Gulf. And in terms of operations, not really impacting the rest of the market.
But we did see, right, when this all initially started to erupt, we did see some initial global ocean cargo spikes, kind of impacting beyond the oil prices. I don't know if that was only related to fuel. I think the last time we did an episode, we were talking about potential for GRIs and for surcharges that were going to be tapped on top of that. Obviously, right, the strait's so much more important from an energy flow perspective, gas and fuel, than for anything else. But what are we seeing now in terms of container spot rates, and is this panning out kind of how we expected last time we spoke?
Yeah. So even if the broader market isn't being impacted operationally, the price of oil impacts a lot of industries, including ocean freight. So we saw early on a lot of announcements of emergency fuel surcharges and then just kind of a lot of other variously named surcharges, peak season surcharges, and other GRIs or FAQs, and things like that. And we, in fact, have seen rates increase on non-impacted lanes. So on the Trans-Pacific, rates were at about $1,800 before the war. The latest rates are at about $2,500, so about $700 increase, similar to the East Coast, similar to for Asia Europe, which went from about 2,400 to 2,900. So there have been price increases, but we haven't seen kind of the extent to which all those rate announcements might have led you to believe rates are going to increase. So rates are certainly increasing, and they're increasing at a time of year where normally rates would be decreasing and kind of leveling off because we're post peak season and we're post Lunar New Year and we're pre peak season. So we're in a low demand period. Nonetheless, we're seeing rates increase somewhat. So this can be attributed to the war. That being said, we're not seeing the extent of increase that carriers were seeking. And for Asia Mediterranean, we've actually seen rates kind of increase and come back down to only about $100 higher than they were and much lower than some of the GRIs that were announced. So we're seeing rates at $3,800 per container, and their GRIs announced for like $5,300 or even $6,000 per container. So rates aren't increasing maybe to the extent that carriers anticipate that they could increase.
Yeah, I mean, totally. Like, I was looking at, I think maybe this is a testament to how bad volatility has been over the past couple of years, but I was just taking a peek at Transpac for 2024, 2025, and 2026, and just like comparing the rates there. And Transpac is actually kind of at the bottom end of where it was over the past couple of years, right? These rates are pretty good. So with a global conflict that is spiking fuel prices across the board, rates are still pretty low, all things considered. Is that a indicator of demand? Have you seen less global container demand, or is there still a lot of talk that kind of shippers are not really looking to move as much product as they were last year?
So on the Trans-Pacific, a little bit, somewhat, because of the trade war, we've seen drops in demand, but globally we've seen increases in volumes throughout that period. So the big factor was really meant to be overcapacity, and that's why we've seen rates kind of decrease year on year since 2024. And that's what the story was likely going to be continuing into this year. rates right now of $2,500 per container in slow season is quite elevated. But for the first part of the year up until the war, we saw rates at about 50% lower than they were last year in January, February 2025. And just in the last few weeks since the war, we've seen rates kind of increase compared to year on year. I think they're about 8% higher year on year for Trans-Pacific, like 20% for Asia, Europe. So this is another factor that's kind of changing the all else being equal kind of supply and demand balance. But overall, we would have expected overcapacity to mean lower rates year on year. And this is another example of kind of, you could call it an external factor that's impacting rates.
So that means that if traffic resumes, if suddenly we wave magic wand and all this goes away, we can expect rates to drop pretty dramatically given the overcapacity. I think maybe good time to shout out if anybody's looking for data on this. And I think Jude also, consistently find that Alpha Liner's data on the order books is a great way to kind of look at how bad that overcapacity is and what's coming up when it comes to new container ships. Maybe looking forward a little bit, what happens, like play it out for us if the strait remains closed, or if traffic continues to just like trickle through rather than opening up like mass, like what does that do for global container trade?
Yeah, well, I think first of all, if it were to kind of reopen, I don't think it's going to be en masse. I think it would be gradual. And in terms of the impact on the larger market, first of all, you might have some congestion as, a bunch of these vessels go out at once, even if it's relatively gradual. More than usual are going to be arriving at times they're not supposed to. So that might cause some congestion in the Far East. But the larger issue for container rates is the price of oil. And from what I've seen, even if the strait reopens completely, it's going to take time for oil and energy levels to get back to where they were. So that would mean higher fuel prices, which should mean higher container rates. The other issue is what happens if it opens very limited or remains closed is not just the price of oil or fuel for a container for the container market, but also availability. So we're already seeing reports of places like Singapore, which is the biggest hub for refueling, that they report they have something like a month left of stock, and that they're very reliant on flows from the Gulf, and that's going to be another problem that is going to mean that carriers need to adjust, and that's going to mean higher costs to them and probably higher rates to shippers and forwarders, and they'll also probably try to reduce their exposure to that, which would mean kind of fewer vessels, which will limit supply and therefore push up rates, or slow steaming, right, and being more fuel efficient, which also effectively soaks up capacity. So I think this isn't going to kind of disappear immediately, even if the straits open up. If they stay limited or closed, it could have additional effects that we haven't really seen yet.
Dramatic turn or dramatic takeoff. Looking at air cargo, what is, I assume that fuel is probably the most dominant impact factor right now on air cargo as well.
Yeah, well, certainly fuel is the story there as well, both fuel costs, like jet fuel costs, and fuel availability. So there's a report this week that Vietnam is reducing some of its domestic flight schedules to kind of conserve supply of jet fuel. And that hasn't gotten to freighters or international freight yet, but if it's gotten to this point, it could mean that it will impact other types of flight, including freight, and other reports that places like South Korea and Philippines are also considering steps like that. So fuel prices and fuel availability are certainly becoming a factor in air cargo. Operationally, the Gulf is actually important to markets beyond the immediate destinations there in the Gulf, in that you have these major carriers, Emirates and Qatar. They make up more than 10% of global capacity, and they have been kind of restricted since the beginning of the war. Qatar really only restarted in the last couple of weeks. UAE has opened their airspace more and more, and so Emirates is getting closer to kind of full capacity. DHL estimates that they're at something like 60% of their normal schedule, and Etihad at 40%. Qatar is still at, or only at 20%, but that's a lot more than it was. So you had this drop of capacity because of these carriers had limited access to their airspace. And so that's kind of gradually improving. But while it's been gone, that's a drain on capacity. And then all those volumes, a big share of them being Asia to Europe that normally would have gone through there, are now have to go directly from Asia. And so you had kind of increase of demand to those lanes. Carriers are adding capacity to those lanes to meet that demand, but there's been kind of this pressure on rates from both of these factors, a drop of capacity and an increase in demand. And so we've seen rates increase really quite significantly. So, for example, South Asia to Europe rates are now more than 60% higher than they were before the war. So now they're above $4 per kilo. Southeast Asia to Europe, 33% higher at $4.50. And Europe to the Middle East, which we can imagine that there's a big drop of access there, have more than doubles. They're almost up at above $3.50. So we're seeing a much more broad and stronger impact on rates and operations in air than we're seeing in ocean. That being said, the last couple of weeks, we've seen rates kind of level off. On some lanes have even decreased a little bit, and that might reflect that the Gulf carriers are recovering their capacity and recovering operations, and also that other carriers are adding flights to the lanes where there's demand. But there's certainly still upward pressure on rates, even if they ease a little bit. And of course, the price of fuel and fuel availability is still the wild card. If that gets more expensive or worse, then you're going to see those costs pass on to forwards and shippers as well.
Yeah, and first of all, maybe a great opportunity to shout out to the carriers that are doing a tremendous job in going back and kind of getting capacity back up now under very challenging conditions. And maybe in contrast to what I was saying before on the ocean front, and air cargo actually is, at least on our global freight index, is a good 25% higher than it's been over the 2024, 2025. Like rates really are very elevated, and maybe that's the best indicator of how disruptive this is on a global level, not just localized to the Middle East. I think the conflict in the Middle East and the Straits are really sucking up a lot of the oxygen in the room. Judith, thanks very much for this. Appreciate it. Catch you next week.